A good long-term investment consistently generates returns higher than inflation and minimizes tax liabilities to maximize real returns. Over the last 30 years, India's inflation rate has averaged 6.3%. This means investment must deliver post-tax returns exceeding this benchmark to be truly profitable. Are your investments keeping up? In India, common options include the stock market, debt instrument, gold, and real estate. But which has performed best over the last 3 decades? In this video, let us analyze these investments. Welcome to holisticinvestment.in. Key investments, how they have performed. Debt instruments. Are PPF and FDs still good investments? Public Provident Fund. PPF has long been a trusted choice for long-term investments. From 1995 to 98, it offered an impressive 12% annual interest rate, gradually declining to 8% by 2003. Rates remained stable until 2008 and increased slightly to 8.6 to 8.7% until 2016, but have since dropped to 7.1% in recent years. Over 30 years, PPF has delivered an average annual return of 8.4% with tax-free interest under the old tax regime. This performance has been reasonable. But at the current rate, 7.1%, can PPF compete with inflation or other investment options? While safe, it may no longer be the best choice for long-term wealth creation. Next, fixed deposits. In 1995, FDs offered a high 12% annual interest rate. Over time, rates fell to 5.4% by 2004, briefly climbed to around 9% in 2015, and have since dropped again to 6.6% in 2023. The 30-year average return for FDs stands at 7.5%, barely surpassing the 6.3% average inflation rate. Once you account for taxes on interest income, FDs struggle to deliver real growth. FDs are better suited for short-term goals, that is under 3 years, where safety and stability are priorities. While PPF and FDs offer safety, their returns of 8.4% and 7.5% may not sufficiently outpace inflation or support significant long-term wealth creation. They are more effective for short-term savings. Next, gold and silver. Are they worth the volatility? Gold jewelry versus financial instruments. Investing in gold jewelry, not ideal. Costs like making charges, wastage, and GST immediately reduces its value by 12% to 15%. Smarter alternatives include gold ETFs and gold savings mutual funds, which eliminate these additional costs. You can also explore silver ETFs and silver savings funds for diversification. Now, let us look at historical performance. Gold has delivered an average annual return of 11% over the past 30 years, consistently outpacing inflation. Silver has also performed well with a 9.7% average return. However, both assets are known for sharp price swings. For instance, in 1995, gold delivered a 12% return, while silver dropped by 22.5%. By 1997, both surged, with gold up 17.4% and silver 22.4%. Despite volatility, gold remains a strong hedge against inflation and economic uncertainty. Its prices soared nearly 30% in 2020 during the COVID-19 pandemic. Silver, influenced by industrial demand, behaves differently. For example, in 2024, silver prices rose by 16.5% due to heightened industrial use. While gold and silver can offer strong long-term returns, they come with inherent volatility. Gold shines during crisis, making it an excellent hedge, while silver's value depends on industrial trends. Are you ready for the unpredictability they bring, or they better reserved for uncertain times? Next, stock market, a roller coaster with promising returns. Investing directly in individual stocks can be risky, but does that mean all stock market investments are high risk? Not necessarily. Indices like the Sensex 30 and Nifty 50, which include the largest and most stable companies, provide safer opportunities for investors. Wouldn't investing in ETFs, index mutual funds, or diversified equity mutual funds based on these indices be a smarter approach for building long-term wealth? The Indian stock market's Sensex index experienced significant 22.5% drop in 1995, followed by a 4.6% dip in 1996. However, it surged by 22.4% in in 1997, only to fall again by 14.5% in 1998. By the year 1999, the index saw a massive 67% rise. Such fluctuations highlight the volatility of stock market returns. Yet, despite these ups and downs, the Sensex has delivered an average annual return of 14% over the past 30 years. Does this growth make the stock market worth the risk, or should you reconsider your long-term strategy due to its volatility? Next, stock market linked mutual funds maximize returns, minimize risk. While the stock market offers high returns, it also comes with significant risk. Stock market linked mutual funds present a way to access these high returns with reduced risk. These funds invest in a diversified portfolio of 30 to 80 stocks, spreading the risk and enhancing the potential for returns. Over the long term, they typically offer returns between 13% and 15%. Additionally, for investments held over a year, returns up to 1.25 lakh are tax-free. Even if returns exceed this amount, the tax is only 12.5%. This seems like a reasonable trade-off for the potential growth. Next, we shall look at the collective data. The data here covers the period between 1994 to September 2024, 30 years and 9 months. The Sensex has delivered the highest average annual return of 14.3%, emerging as one of the strongest performers over the last 3 decades. Each investment type has its own strengths and weaknesses, making it crucial to select one that fits your financial goals and risk tolerance. Which investment will you choose to secure your financial future over the next 30 years? Next, asset allocation, a strategy for steady growth. Different investments excel under varying market conditions. But what if you could blend them together to balance risk and maximize returns? An asset allocation strategy allows you to diversify your investment, potentially earning an average return of 12% to 14% per year over the long term. Wouldn't it be wise to distribute your investments across different assets? This approach not only reduces risk but also increases the likelihood of higher returns, giving you a better chance at financial growth. Here is the final part, key takeaways. Stock market, an average annual return of 14.3% over 30 years, but with considerable volatility. Public Provident Fund, average return of 8.4%, tax-free, but may not keep up with inflation at current rates. Fixed deposits, average return of 7.5%, but struggles to outpace inflation after tax deductions. Gold, average annual return of 7.5%, volatile with additional cost, but performs well during global crisis. Silver, average return of 11.1%, volatile and influenced by industrial demand. Real estate, average return of 9.7%, but low rental yields and liquidity challenges. Stock market linked mutual funds, annual return between 13% and 15%, reduced risk with tax-free returns up to 1.25 lakh for long-term investors. Asset allocation, diversifying across different assets could yield an average return of 12 to 14%, balancing risk while maximizing returns. A detailed blog post on this topic is available on our website and the link is given in the description.
இந்த வீடியோ உங்களுக்கு பயனுள்ளதாக இருக்குன்னு நினைக்கிறோம். உங்களுக்கு முதலீடுகள் பற்றி ஏதாவது சந்தேகங்கள் இருந்தாலோ அல்லது எங்களோட சர்டிஃபைட் ஃபினான்ஷியல் பிளானர் மூலமாக உங்களுக்குன்னு ஒரு பர்சனலைஸ்டு ஃபினான்ஷியல் பிளானிங் பண்ணணும்னு விருப்பம் இருந்தாலோ இந்த வீடியோவோட டிஸ்கிரிப்ஷன் பாக்ஸில் இருக்கிற 30 minute காம்ப்ளிமெண்ட்ரி அப்பாயின்மெண்ட் லிங்கை பயன்படுத்தி உங்களோட அப்பாயின்மெண்ட்டை ஃபிக்ஸ் பண்ணிக்கலாம். இந்த வீடியோ உங்களுக்கு பிடிச்சிருந்தா லைக் பண்ணுங்கள், மறக்காமல் எங்களோட யூடியூப் சேனலை சப்ஸ்கிரைப் பண்ணுங்கள்.